Hi folks, it's Björn here, and just that you guys are informed, next week I will be lying on the beach with the margarita in my hands, and therefore there will be only one video. But given what's going on in the stock market right now, I felt like it would be appropriate to address everyone's concerns and share my thoughts about what's going on right now and what you should and shouldn't do in the current situation. See, I'm worried that most of the people who only just recently started investing and have never been through or seen what a bear market or recession looks like, because it's really one thing to say we should buy the dip, or on the other side, the entire market is down and you start seeing serious losses in your account and watch all of your profit gone in a matter of days, and therefore you panic selling as you never have experienced something like that. So you see, we have a lot of ground to cover, therefore I'm sorry that the video will be a long one, but I recommend to watch the whole video in order to get the full picture. And no worries, I will try to make it as simple as possible. Means you don't have to be a nerd in order to understand it. And if you like informations like this, then please hit the like button and consider subscribing for more daily updates and infos. That being said, grab a coffee, sit tight, and let me explain. It's worth explaining what's going on right now and why the stock market is looking like to go to crash. The first has to do with the Federal Reserve. The issue we have now is that record low interest rates combined with easy money such as stimulus checks, having supply chain bottlenecks and a shortage in labor force with excessive demand cause price to rise at their highest level in 40 years. Otherwise, what's known as inflation. Although since this inflation is harder and more severe than the Federal Reserve anticipated. So right now they are taking measures that would prevent inflation from rising even faster. But that has another effect, and that would be decreasing risk. Simply put, studies show that when interest rates are at record heights, people are more likely to avoid riskier investments, such as overvalued high growth stocks, as we could see during the periods of economic stress, such as financial crisis that began in 2007. Fearful investors tend to seek the safety of treasury bonds as well as government agency bonds and FDIC insured CDs. When they do so, they forego the risk premiums available from non-treasury debt and equity investments. By driving interest rates down, increasing the price of avoiding risk. We see that the Federal Reserve actions lead many investors to increase risk taking. This behavior helps boost capital markets and stimulate the economy, nudging investors to take on more risk than they should, and that is what we have seen, ladies and gentlemen. And it also leads people to take on excessive risk that they might not be able to handle, and that's prone to disaster, especially when interest rates increase like we are beginning to see today. Second, slowing growth. Even though this is certainly not the deciding factor, a sudden 24% decline in Netflix stock or even Procter & Gamble's growth is affected by the inflation, could be a precursor for other companies that if their growth begins to slow, that could reflect the declining consumer demand across everything. As the customers have already made their major purchases, they have already subscribed to streaming services, and we are unlikely to see that same explosive growth in the future. Another important point are their higher costs. The best way to explain it is like this. Rising inflation and supply chain bottlenecks have caused the price of everyday items to increase, making it significantly more expensive. Anytime you want to buy groceries, building materials, energy, gasoline, or pretty much anything and add the workers' shortage to it, which by the way is not a shortage per se, as there are plenty of jobs to fill, but as most got stimulus checks and on top of it expand child tax credit for families and the extension of enhanced unemployment benefits, the Biden stimulus pushed the bank accounts of even the lowest income Americans to unexpected heights. On average, they had more than twice as much in their savings accounts as they did when the pandemic began. Well, given that, you have time to think about minimum wages, but fun fact, even companies who pay way above have problems to find persons who want to work for it actually. means even more people during the corona pandemic were actually thinking about if they like their jobs or not, and plenty of them therefore taking a break or changed their profession or went into a retirement. Hence, companies have to pay way more than before. I'm not saying here that the increase would mean or outweigh the inflation and rising costs of living. In fact, they don't mostly. Given all the factors, plus Omicron entering China right now and with their zero COVID approach and therefore locking up entire cities where millions of people live, we could see another supply chain issue for this year. Be aware of that, folks. So, to sum all this up, due to more money in our pockets during Corona with the stimulus checks and the child tax credit, or the fact that students don't have to pay for their student loans, therefore combined with the supply chain issues, that's it what increased the inflation. Given that, I expect that households will have less money as they won't probably get any more stimulus checks and have to eventually pay back their loans, and prices go even higher, and on the other side still having supply chain issues, hence production is going down and is leading to increase the prices here as well, etc, etc, etc. Plus the Fed raising interest rates, and when interest rates go up, borrowing becomes more expensive for both consumers and companies. That can hurt profit margins for companies and make stocks less attractive to investors, while sapping consumer demand because people have less money to spend if their mortgages and other loan payments go up. Over time, that tends to deflate the stock market and reduce demand, which brings inflation back under control. So, I expect for 2022 to be a bumpier ride because the returns are not going to come as easy as they did in 2021 or most of 2020. So even if the economy continues to grow, there will be concerns about valuation as the Fed tightens policy that will lead to some heightened volatility. But Björn, how we can profit from all of that and what should or shouldn't I do? Well, no one has any clue what's going to happen in the short term. And the best strategy is always to keep buying and holding, folks. But whether or not people actually follow that advice is a totally different story. It's just so easy to believe in the concept of buying the dip and keep holding when everything just keeps going up. That being said, but very few people ever actually follow this advice when prices keep going down. And you think to yourself or read, for example, in forums, I have had enough of these losses, the market is rigged, the stock market is very evil, so I'm just going to pull out all the money and then just see what happens later. So it's going to test a lot of people's nerves and endurance, and whether or not they are able to come out of this as a better investor, even though no one knows what's going to happen or how quickly this is going to blow over or how much worse things could get. So my first advice, do not panic from scary headlines and continue investing as usual. Even though the recent market performance is weird and more than a third of the Nasdaq is down more than 50%, but in the big picture, this is really just a hiccup. And it's not even close to the worst that we've seen in the past. Just have a look at this graph. The S&P 500 is down 8.5% over the past month, which I marked in red. But year over year, we are still up 18%. And over the last 5 years, we are up 95%, which I have marked in green. And the market crash that you're worried about today is this little line here. That's it. When you zoom out even further, that is what's causing you so much panic. That's it. That's nothing compared to the dot-com crash in 2008 financial crisis. I hope that helps and put things into perspective, and from my own experience purely from an investment standpoint, it's usually these times that offer a great opportunity, as statistically crashes are good folks, and investors who stayed invested and invest in a crash have more gains than someone who stops investing or even sells, which would be the worst. So If you have debts, pay them as soon as possible, that you are debt free as for the rising interest rates, etc., etc. And if you find yourself in a stable position right now where you have a stable source of income, you have an emergency fund and you have low living expenses, you are totally ready to go right now. And I recommend you to put your situation to good use and invest in these golden nuggets. They were too expensive before, but you always wanted to have, but now going down. So in my opinion, a lot of this panic is simply due to slowing growth, higher costs, higher inflation and higher rates. Now, don't get me wrong, I have no idea what's going to happen to the markets in the short term, but things don't just go up indefinitely or forever. And instead of being fearful about losing money, we should use the opportunity to buy little by little these little gems we always wanted at a cheaper price. And a little recommendation from my side, buy in tranches, but look at the rate of your broker. What I mean by that, if up from $500 or $1,000 for example, it's free, then buy not less for the cost average sake. And then little by little buy more, as we don't know how far the stock or the market will go down and correct, and continue to do so. It is a process everyone has to go through. Earlier the better. But let me know in the comments what you ladies and gentlemen think, and I'm using this term and not guys, as we have in fact as well ladies in our community. So please write in the comments or even use it as kind of forum to ask or answer questions. That being said, if you like the video, please give me a thumbs up so that other retail investors like you and me have the chance to see this video as well. And if you're on my channel for the first time, I would be happy if you would subscribe, because I regularly produce new videos and tutorials on the topics of stock analysis, investment and financial products to give you the opportunity to take your finances into your own hands. That being said, if you like the content and you want to support my channel with a few bucks so I can produce more videos, I will pin the link to my Patreon page in the comments below. That's it for today. Thanks for watching, and as always, stay focused and don't be greedy. See you next time.